Tonight's Asian market opening is not just another trading session. It represents a pressure point where multiple forces collide at once. Across global exchanges, the cost of holding silver contracts has surged dramatically within days, leaving traders scrambling to reassess risk. Physical supply chains are tightening, retail dealers are pulling inventory from shelves, and buyers are reporting unusual premiums over official market prices. When the Asian session begins, traders will face a decision between paper valuations and real-world scarcity. Markets cannot sustain contradictions forever, and the current divergence between futures contracts and physical demand is reaching a critical threshold. The coming hours may reveal whether financial pricing mechanisms still control the narrative or whether real-world supply constraints will force a reevaluation. Experienced investors recognize that such moments rarely arrive quietly. They appear suddenly, often disguised as routine sessions, yet they end up defining entire market cycles long after the initial headlines fade. Before diving deeper, consider what this channel represents for viewers who return regularly. It is not about hype or noise, but about quietly examining patterns that others overlook. Many experienced investors learn to listen to subtle shifts long before markets erupt into chaos. Think of that cautious voice in your life that sensed change before everyone else noticed. Financial markets function similarly. Early signals rarely scream for attention, yet they hold immense value for those willing to observe carefully. The purpose here is not to predict with certainty, but to frame complex developments in ways that help investors think critically. The events unfolding tonight may look sudden to outsiders, but seasoned watchers know they have been building for weeks. Every margin adjustment, inventory shortage, and price discrepancy contributes to a larger narrative. Understanding that narrative is what separates reactionary trading from thoughtful, strategic positioning in volatile global markets. The year is 2025, and the financial structure behind precious metals is quietly shifting beneath the surface. Exchanges, regulators, and institutional participants are adjusting policies in response to volatility and evolving supply conditions. Many of these changes occur without dramatic press releases or public debates. Instead, they appear as technical updates that only dedicated traders notice immediately. Such was the case when a major futures exchange implemented sudden adjustments to precious metals trading requirements. To the general public, the move looked routine, almost administrative. But to professionals, it signaled rising tension within the system. Whenever an exchange alters the cost of participation significantly, it reflects deeper concerns about risk exposure and market stability. These changes rarely exist in isolation. They interact with global liquidity conditions, investor sentiment, and geopolitical pressures. When multiple adjustments occur within days, experienced observers recognize a pattern emerging rather than a single isolated decision. Understanding margin requirements is essential to grasp why recent developments matter so deeply. Futures contracts allow traders to control large quantities of commodities without paying the full upfront price. Instead, they deposit a margin, which acts as a form of collateral against potential losses. This mechanism provides leverage, enabling participants to amplify exposure with relatively small capital. However, when exchanges raise margin requirements, they effectively increase the financial barrier to holding positions. Traders must suddenly commit significantly more capital or reduce their exposure. For institutional investors with large reserves, this adjustment may be manageable. For smaller participants, it can be devastating. A sharp increase can force liquidations, even if the underlying investment thesis remains unchanged. Therefore, margin hikes do more than manage risk. They reshape the participant landscape itself. When applied during periods of volatility, they can accelerate price movements by pushing weaker hands out of the market entirely. Recent margin adjustments across precious metals contracts have been substantial rather than incremental. Gold, silver, platinum, and palladium all experienced significant increases within a short time frame. These were not minor percentage tweaks meant to fine-tune risk models. Instead, they represented sharp changes that dramatically altered the economics of holding positions. Traders who previously managed comfortable leverage ratios suddenly faced new capital demands. For many, the decision was simple but painful. Deposit more funds immediately or close positions. Such decisions ripple through the market rapidly because each forced exit adds selling pressure. When margin increases occur back-to-back within days, the cumulative effect intensifies. Markets become more fragile as participants reassess their strategies simultaneously. Even investors who remain confident in long-term fundamentals must contend with short-term liquidity constraints. In highly leveraged markets like silver futures, these structural changes can become catalysts for rapid price swings independent of underlying demand. Silver traders felt the most dramatic impact from recent margin changes. The cost required to maintain a single contract more than doubled within a short period, transforming what was once an accessible position into a high capital commitment. For experienced investors, sudden financial strain often leads to rushed decisions. Some reduce exposure to preserve liquidity. Others are forced out by automated risk systems. Smaller traders, who frequently drive speculative momentum, are particularly vulnerable to such shocks. Their exit changes the market's emotional tone, replacing optimism with caution. Meanwhile, larger institutional players may benefit from reduced competition and increased volatility. This dynamic creates an environment where prices can move sharply, even without major shifts in supply or demand. Understanding this structural pressure is critical because it influences behavior long before headlines acknowledge its effects. When traders cannot afford to maintain positions, price direction becomes less about conviction and more about survival within tightening financial constraints. Exchanges justify margin increases primarily as risk management tools. During periods of extreme volatility, clearinghouses must protect themselves against potential default risks. If traders incur losses larger than their deposits, the exchange bears financial exposure. By raising margin requirements, exchanges aim to ensure participants can absorb sudden price swings. On the surface, this rationale appears logical and responsible. Recent market behavior has indeed been unusually volatile, with sharp daily price movements that challenge traditional risk models. However, the timing of such adjustments often sparks debate within trading communities. Critics argue that implementing significant increases immediately after dramatic price declines can intensify downward pressure rather than stabilize markets. While exchanges insist they are neutral risk managers, traders sometimes perceive these moves as catalysts that accelerate trends already in motion. Regardless of interpretation, the practical outcome remains the same. Participants must adjust quickly or face forced liquidation. Market observers have also pointed to the sequence of institutional activity surrounding recent price movements. Large financial entities reportedly closed significant positions near major turning points, raising questions among independent analysts. While such behavior may reflect routine portfolio management, it adds to the perception that powerful players adapt faster than retail participants. When margin hikes follow closely after major institutional moves, skepticism naturally emerges. Traders begin to wonder whether structural adjustments unintentionally benefit larger players who possess deeper capital reserves. Whether intentional or coincidental, the perception itself can influence sentiment dramatically. Markets thrive on confidence, and when participants believe rules may favor certain groups, trust erodes. This erosion can lead to defensive trading behavior, increased volatility, and sudden price swings. Ultimately, even rumors and speculation about institutional advantages become part of the market's psychological landscape, shaping decisions alongside objective data. Forced selling is one of the most powerful accelerants in financial markets. Unlike voluntary profit-taking, it occurs when traders have no choice but to exit positions due to margin calls or risk limits. As prices fall and margin requirements rise, liquidation cascades can develop quickly. Each sale pushes prices lower, triggering additional margin calls for remaining participants. This chain reaction creates sudden drops that appear disconnected from fundamentals. In highly leveraged commodities like silver, forced selling can overwhelm genuine demand temporarily. Investors watching charts may interpret sharp declines as signals of weak fundamentals, even when physical demand remains strong. Understanding this dynamic helps explain why markets sometimes experience dramatic short-term moves that later reverse. Structural pressure, rather than fundamental change, becomes the driving force. When enough traders face financial constraints simultaneously, the market becomes a battleground between liquidity needs and long-term conviction. As the Asian session approaches, traders are less focused on predicting long-term direction and more concerned with immediate survival. The central question is no longer simply whether silver will rise or fall, but whether participants can afford to maintain exposure under new rules. Margin calls do not negotiate. They require immediate action. Traders must evaluate available capital, risk tolerance, and potential volatility before markets reopen. For some, the safest decision may be to reduce exposure before the session begins. Others may view current pressure as an opportunity to accumulate positions at discounted prices. These conflicting strategies create tension that often manifests as extreme opening volatility. Asian markets play a crucial role because they introduce new liquidity pools and different investor psychology compared to Western sessions. The initial reaction from Asian traders may set the tone for global markets, shaping narratives that ripple across continents throughout the trading week. While futures markets struggle with structural changes, the physical silver market tells a different story. Reports from dealers indicate increasing difficulty sourcing inventory despite declining paper prices. Customers attempting to purchase physical bars encounter delays, higher premiums, or outright stock shortages. Such developments are significant because physical markets often reflect underlying demand more directly than derivatives markets. When buyers rush to secure tangible assets during periods of uncertainty, supply chains tighten quickly. Dealers must compete for limited inventory, which raises costs and extends delivery timelines. These real-world challenges contrast sharply with the impression created by falling futures prices. For experienced investors, this divergence raises critical questions about which market better reflects reality. Physical scarcity suggests ongoing demand strength even as paper valuations fluctuate dramatically. Historically, such discrepancies have preceded significant adjustments as markets eventually reconcile conflicting signals. Major bullion dealers and mints have reportedly paused or limited silver sales due to sourcing challenges. For longtime observers, such actions represent more than routine logistical delays. Precious metals dealers typically operate through volatile cycles, maintaining operations even during dramatic price swings. When multiple well-known suppliers reduce activity simultaneously, it indicates unusual strain on supply networks. This strain may stem from surging demand, transportation disruptions, refining bottlenecks, or a combination of factors. Regardless of cause, the outcome remains consistent: fewer physical ounces available to meet buyer interest. Investors often view dealer shutdowns as warning signals because they highlight tangible scarcity rather than theoretical shortages. When customers cannot acquire metal despite declining prices, it suggests that futures markets may not fully capture real-world conditions. This disconnect becomes a central theme as markets approach pivotal trading sessions. Understanding the distinction between paper silver and physical silver is essential for interpreting current events. Paper silver exists primarily as contracts, derivatives, or financial instruments representing future delivery. These products provide liquidity and allow investors to speculate on price movements without handling physical metal. Physical silver, by contrast, involves tangible bars and coins, stored, transported, and secured in real facilities. Each form serves legitimate purposes within global markets. However, their pricing can diverge during periods of stress. Paper markets may experience rapid fluctuations driven by leverage, speculation, and automated trading systems. Physical markets respond more directly to supply constraints, manufacturing needs, and investor hoarding behavior. When both markets align, price discovery functions smoothly. When they diverge significantly, confusion and mistrust can emerge. Investors must understand which market they are analyzing because each reflects different forces and timelines. Recent events have highlighted a stark contrast between these two forms of silver trading. Futures markets experienced sharp declines, while physical demand reportedly surged. Buyers seeking tangible metal encountered higher premiums despite falling spot prices. This phenomenon creates a scenario known as market dislocation, where official pricing mechanisms fail to reflect real-world availability. Dislocations challenge traditional assumptions about efficient markets. Investors accustomed to trusting futures prices as accurate reflections of value must reconsider their approach when premiums rise dramatically. Dealers may justify higher prices based on sourcing costs, shipping delays, or increased risk. Meanwhile, futures traders may focus on macroeconomic data or technical patterns driving price declines. The result is two parallel narratives about the same asset. Such situations rarely persist indefinitely because arbitrage opportunities eventually encourage convergence. However, the path toward reconciliation can involve significant volatility and unexpected price movements. Historical precedents provide valuable context for understanding current conditions. During past crises, including periods of global economic uncertainty, precious metals markets experienced similar divergences between paper and physical pricing. Dealers reported shortages while futures contracts fluctuated rapidly. Eventually, prices adjusted as physical demand forced recognition of underlying scarcity. These episodes remind investors that markets operate within both financial and logistical realities. While derivatives offer flexibility and liquidity, they cannot override physical constraints indefinitely. Production costs, mining output, and industrial demand ultimately shape long-term pricing trends. When physical buyers step in aggressively during price declines, they create a foundation for potential rebounds. However, timing remains unpredictable because structural pressures within futures markets can prolong dislocations. Understanding historical cycles helps investors remain patient and avoid overreacting to short-term noise during periods of uncertainty. International pricing differences further complicate the current silver narrative. Regional markets often reflect unique supply conditions, currency fluctuations, and local demand patterns. In Asia, particularly China, strong retail and industrial interest can drive prices above Western benchmarks. When premiums widen significantly between regions, it indicates imbalances in global distribution networks. Traders may attempt to exploit arbitrage opportunities by moving metal across borders, but logistical challenges and regulatory constraints can limit such strategies. Large pricing gaps also influence investor psychology, prompting questions about which market offers the most accurate reflection of value. If Asian buyers consistently pay higher prices, Western traders may reconsider their assumptions about supply and demand. Conversely, if futures markets maintain lower prices, some investors may view regional premiums as temporary distortions rather than structural changes. The interplay between these perspectives shapes global sentiment as markets approach critical sessions. Online marketplaces in major Asian economies provide additional insight into physical demand trends. Listings for silver bars often include significant premiums above official futures prices, reflecting strong consumer interest and limited availability. These platforms function as real-time indicators of retail sentiment because they capture thousands of individual transactions rather than institutional trades. When everyday buyers willingly pay substantial markups, it signals confidence in silver's long-term value or concern about currency stability. Such behavior can influence broader market narratives by highlighting demand beyond institutional speculation. Analysts monitoring these platforms often treat them as early warning systems for supply shortages. When premiums persist despite falling global prices, it suggests that official benchmarks may underestimate underlying demand. This divergence becomes especially significant when approaching major trading sessions that could determine whether futures markets adjust upward or physical premiums decline. A key concept emerging from current analysis is the idea of fundamental value. Analysts estimate theoretical pricing based on mining costs, industrial usage, investment demand, and inventory levels. Some projections suggest silver's equilibrium price lies significantly above recent futures valuations. While such models are inherently imperfect, they provide useful reference points for assessing potential mispricing. When market prices fall substantially below estimated fundamentals, value-focused investors often step in to accumulate positions. Their participation can create support levels that stabilize markets after sharp declines. However, structural pressures, like margin hikes or forced selling, can temporarily override fundamental signals. Investors must therefore balance long-term valuation models with short-term liquidity considerations. Understanding both perspectives allows traders to navigate volatile periods without losing sight of broader trends shaping commodity markets. Historical data indicates that significant discounts relative to fundamental estimates rarely persist indefinitely. Markets eventually adjust as producers reduce output, buyers increase accumulation, or arbitrage opportunities emerge. These adjustments can occur gradually or through sudden price spikes depending on prevailing conditions. When discounts become extreme, they attract attention from institutional investors seeking undervalued assets. Their participation can accelerate reversals once structural pressures ease. However, patience remains crucial because timing such corrections precisely is notoriously difficult. Many traders underestimate the duration of dislocations, leading to premature entries or emotional decision-making. Recognizing that corrections follow unpredictable timelines helps investors maintain disciplined strategies. Rather than focusing solely on immediate price movements, experienced participants monitor structural indicators like inventory levels, regional premiums, and exchange policies to gauge when convergence becomes more likely. All current developments converge toward the upcoming Asian session, which may act as a catalyst for market reassessment. Trading activity during this window often sets the tone for global markets because it introduces new participants with distinct perspectives. Asian investors may react differently to margin hikes or supply shortages compared to Western traders. Cultural factors, regulatory environments, and local economic conditions influence decision-making processes. If Asian buyers continue to prioritize physical acquisition despite falling futures prices, they may apply upward pressure on global benchmarks. Conversely, if leveraged traders respond to margin increases with widespread liquidation, short-term volatility could intensify. The interaction between these forces makes the opening session particularly significant. Observers worldwide will monitor price reactions closely for clues about which narrative, paper valuation, or physical scarcity, gains dominance. Moments like this reveal deeper truths about financial systems beyond immediate price action. Markets often operate on trust, assumptions, and complex financial engineering. When contradictions emerge between official pricing and tangible reality, they expose vulnerabilities within those structures. Investors begin questioning whether derivatives accurately represent underlying assets. Such doubts can trigger broader reevaluations of risk management strategies and asset allocation decisions. Even if markets stabilize quickly, the psychological impact of dislocation lingers. Participants become more cautious, diversify holdings, or shift toward physical ownership models. These behavioral changes influence long-term trends beyond the initial crisis. Therefore, tonight, DES session may hold significance not only for short-term trading, but also for how investors perceive precious metals markets in the years ahead. To analyze potential outcomes objectively, it helps to break current conditions into interconnected threads. The first thread involves exchange policies and margin requirements that increase financial pressure on leveraged traders. The second thread concerns physical supply constraints that create real-world scarcity despite declining prices. The third thread centers on global pricing discrepancies, reflecting regional demand imbalances. Each factor alone could influence markets significantly. Together, they create a complex environment where traditional analysis becomes challenging. Understanding how these threads interact provides a framework for evaluating possible scenarios, rather than relying on single-factor predictions. Markets rarely move based on one variable alone. They respond to the cumulative effect of structural, psychological, and logistical forces unfolding simultaneously. One possible scenario involves continued strong physical demand in Asia, maintaining upward pressure on global pricing. If buyers persist in acquiring metal at elevated premiums, futures markets may eventually adjust to reflect underlying scarcity. Dealers would remain unable to replenish inventory quickly, reinforcing the perception of supply shortages. Under such conditions, paper prices might experience sharp upward corrections as traders rush to close short positions. This outcome would not necessarily represent speculative hype, but rather a mathematical reconciliation between physical availability and financial valuation. However, rapid price increases could introduce new volatility as traders attempt to reposition quickly. Investors must therefore differentiate between sustainable structural shifts and short-term speculative spikes when evaluating potential market reactions. An alternative scenario centers on the impact of margin hikes, forcing widespread liquidation among leveraged traders. If many participants cannot meet new deposit requirements, they may exit positions en masse during the Asian session. This forced selling could push futures prices even lower temporarily, widening the gap between paper and physical markets. Such declines might appear alarming to casual observers, yet they could reflect structural pressures rather than deteriorating fundamentals. Physical buyers might interpret falling prices as opportunities, further increasing demand for tangible metal. This divergence would deepen dislocation, but also set the stage for a potentially larger future correction. Understanding this possibility helps investors avoid emotional reactions to short-term declines that stem from liquidity constraints. Regardless of which scenario unfolds initially, certain indicators will provide valuable insight during the session. Regional spot prices, particularly in major Asian trading hubs, will reveal whether physical demand remains strong. If premiums persist or expand, it suggests ongoing scarcity. Futures market volume and volatility will indicate whether forced liquidations dominate early trading hours. Sudden spikes in volume accompanied by sharp price swings often signal structural adjustments rather than organic market sentiment. Additionally, announcements from bullion dealers regarding inventory availability can offer real-time clues about supply conditions. Monitoring these factors together allows investors to interpret market movements more accurately rather than relying solely on headline price changes. It is essential to approach this moment with realistic expectations. No single trading session can resolve complex structural issues entirely. Markets may react dramatically at first, then stabilize as participants reassess conditions. Some investors may attempt to capitalize on volatility through short-term strategies, while others focus on long-term positioning based on fundamental analysis. Both approaches carry risks, especially during periods of uncertainty. Rather than viewing the session as a guaranteed turning point, experienced observers treat it as an information-gathering opportunity. The behavior of traders, dealers, and regional markets will reveal valuable clues about future trends. By maintaining a disciplined mindset, investors can extract insights without becoming overwhelmed by immediate price fluctuations. Another factor to consider is the role of algorithmic trading systems that dominate modern futures markets. Automated strategies respond rapidly to margin changes, volatility spikes, and liquidity conditions. When multiple algorithms react simultaneously, they can amplify price movements beyond what human traders might produce alone. These systems may trigger cascading orders that intensify both upward and downward trends. Understanding their influence helps explain why markets sometimes move faster than expected following structural announcements. And while algorithms increase efficiency under normal conditions, they can exacerbate dislocations during periods of stress. Investors must therefore account for technological dynamics alongside traditional economic analysis when interpreting rapid price changes during critical sessions. Psychology also plays a crucial role in shaping market reactions. Fear of missing out